Ray Dalio, a self-made billionaire investor and influential economist, recently expressed his concerns about the potential for a large-scale global war. In just 2 years, he has increased his estimate of the likelihood of such a conflict from 35% to 50%. He shared these thoughts in a LinkedIn post titled "Another Step Toward International War." In his post, he highlighted the growing tensions stemming from geopolitical events involving Israel, Hamas, Russia, Ukraine, China, and Taiwan. He believes that the current escalation is a crucial moment in the establishment of a new world order. Dalio emphasizes that these events are not isolated incidents, but part of broader global power dynamics that are reshaping the world. He draws parallels between the current geopolitical climate and the situations that led to the two world wars in the 20th century. In this video, we will discuss 3 stable and growing companies with credit ratings even higher than that of the US government. Dalio notes that the issues between Israel, Hamas, Russia, and Ukraine are not isolated conflicts, but indicative of larger power struggles that could potentially involve allies and lead to more extensive wars. He also points out the indirect involvement of the US in proxy wars in Europe and the Middle East and its preparations for possible conflicts in East Asia. The expansion of these conflicts could draw in even neutral countries, resulting in greater scale and devastation. Regarding potential solutions, Dalio hopes that global leaders will come together to understand the devastating consequences of war and collaborate to prevent it. However, he remains skeptical about the possibility of such an idealistic outcome and suggests that a large-scale conflict may be inevitable. Amidst all this uncertainty, Ray Dalio is investing heavily in 3 stocks to earn a safe and substantial return, with little to no worries. One of the first stocks that Ray Dalio is adding to his portfolio for a safe haven is Johnson & Johnson, with the ticker symbol J&J. Johnson & Johnson, a well-known healthcare company, is placing strong emphasis on its pharmaceutical and medical technology sectors, making it an excellent choice for a defensive stock, especially in the face of current market uncertainties. J&J offers a stable 3% dividend yield, and its profits are steadily growing, making it a secure investment option. Often referred to as the ultimate ultra swan, J&J boasts an impressive AAA credit rating, a 60-year track record of dividend growth, and notably low volatility at just 15%. This low volatility makes it even more stable than most individual companies, with a growth rate of approximately 5% and a reliable 3% yield. J&J is expected to provide an 8% return in the long run. Furthermore, there's a 15% discount that suggests investors may potentially outperform the S&P in the coming years, with less volatility and a considerably safer yield. Achieving financial milestones doesn't necessarily require extraordinary intelligence. Instead, it demands the emotional resilience to stick to a strategy, even in challenging times. In light of a recent market downturn, J&J's stock value is now undervalued, aligning its returns closely with the S&P 500. Its 3% dividend yield is highly reliable, nearly twice as much as the S&P's 1.6% yield. While J&J might not offer quick riches, it can serve as a stable anchor during turbulent market periods, making it an appealing option for cautious dividend investors preparing for future uncertainties. Despite a 13% decline this year, while the S&P 500 index surged by 11%, J&J's performance remains solid. Its consistent 6-decade dividend growth is a testament to its dividend stability, further supported by its favorable adjusted diluted EPS payout ratio of 47%, comfortably below the industry's safe benchmark of 60%, ensuring dividend reliability. Notably, J&J and Microsoft are the only S&P 500 members with a perfect AAA credit rating, a feat even the US government no longer holds. This emphasizes J&J's minimal bankruptcy risk over the next 3 decades. Given J&J's stable dividend and robust financial standing, the company offers a significant safety margin, making it an attractive option for income-focused investors. Ray Dalio's second pick for his portfolio is Visa, a dominant force in the electronic payments industry. As the world moves beyond the pandemic, electronic transactions are surging, and Visa's shares are currently priced at a 14% discount from their historical averages. Visa has displayed impressive dividend growth, increasing dividends by a remarkable 350% over the past decade, with no signs of slowing down. In comparison to its peer, MasterCard, Visa stands out due to its strategic foresight and competitive edge, positioning itself for a digital, cashless future. Visa's economic model, characterized by low capital investment, has propelled it to the top of the industry in terms of profitability. Its operations serve as a bridge for electronic payments between consumers and businesses, earning fees with each transaction. The more Visa cards in circulation and higher transaction volumes, the better for its revenue. With a 90% increase increase in the US's M2 money supply over the past decade, Visa appears poised for a promising future. In Q3 fiscal year 2023, Visa demonstrated remarkable operational efficiency, with a gross margin of 98% and a net margin of 51%, surpassing tech giants like Microsoft and Apple. Visa's financial health is solid, boasting a debt of only $3.92 billion and a market valuation of $477 billion, along with an AA- credit rating. In the debit and credit card issuance market, Visa dominates with a substantial 61% global share. Historically, Visa has shown impressive growth, with a 119% increase in revenue over the past decade. The company's alignment with tech-centric financial services positions it favorably for the future, and it's presently trading at a notable discount relative to its historical metrics. Considering projected growth until 2030, Visa's stock holds potential to reach $458 by the end of the decade. This makes it a compelling choice for investors looking for long-term growth and stability in the electronic payments sector. Ray Dalio's third pick for his portfolio is Alphabet, also known as Google. Regardless of global events, Google will always be at the forefront of information and search. However, the market appears to undervalue Google's potential in the realm of artificial intelligence, making its stock a potential buy. One notable area of growth for Google is its chatbot, Bard. Bard is built on large language models and has distinct advantages over OpenAI's ChatGPT. For instance, Bard can fetch and use more up-to-date information from the internet, giving it a real-time data advantage. This, coupled with Google's vast data resources, can enhance digital advertising by providing insights that might otherwise go unnoticed. Google's DeepMind is also making strides in AI with its product, Gemini. Unlike many existing AI products that are limited to text, Gemini is expected to handle various data types, including text, images, and intricate codes. This versatility positions it as a significant innovation in the AI domain. Data suggests that while ChatGPT continues to dominate the generative AI scene, its growth trajectory has slowed down. In contrast, Google Bard has experienced exponential growth, solidifying Google's credibility in this space. Google's stock currently trades at a valuation lower than other major tech companies. However, when considering the company's genuine economic earnings, the valuation becomes even more attractive. Analysts project an annual return of around 12% over the next 3 to 5 years for Google, based on factors such as the company's return on capital employed, ROCE, and reinvestment rate. This makes Google an appealing choice for investors looking for a tech stock with strong growth potential in the AI sector. In closing, Ray Dalio's investment selections in Johnson & Johnson, Visa, and Alphabet demonstrate his faith in enduring solid assets. These stocks are poised to thrive amid market fluctuations and seize opportunities in healthcare, digital payments, and artificial intelligence. If you found this information valuable, please don't forget to like, comment, and subscribe for more insights. See you next time.